Also, Ron Bertino, who is here tonight and asked the questions, the most questions toward the end there, has his own community, or is part of, I should say, another community, which is called Trading Dominion, which is focused on some of these same areas. And so, Ron, if you want to present your take on this whole area, or just chat a little bit about it in any case, or on what one might find at Trading Dominion that would be relevant to that, and you're welcome to do so.
Sure. Okay. Well, I'll just give you, I guess, some thoughts on what was presented here, and I'm happy to answer questions as well. So I thought Jason did a great job. He comes across as a very smart guy, knows his stuff. All of the strategies that he is tapping into, I think, are fine. There was surprisingly nothing that he covered where I'm like, nope, wrong, or whatever.
I'm surprised. I'm surprised.
It's pretty rare these days, but that was interesting. Mind you, he was really just talking quite high level, right? To be fair. So whereas, we've had some of the presentations where they go into the specifics and I can kind of nitpick stuff there. Whereas here it was quite high level. I mean, if I just recap from the notes that I took here, he's basically saying at the money straddles, primarily in indexes, but also in some names. He then mentioned that they're ratioed, which basically means that they're really, and he confirmed this, right, that they're not really delta neutral, that they're directional trades. So you need directional trading skills in order to do that. And then he also confirmed that there's some discretion involved. So you don't just need directional trading skills, you need to be good at it and consistent so that you're not going to panic, right, when the crap hits the fan and all that kind of stuff. He then mentioned doing long strangles to cover a 20 to 40% move down, but it's essentially, a long vol play that's similar in nature to the at the money straddle, but I'm assuming that this is also directional because he said that the person that's managing that will sometimes do strangles, will sometimes do long puts only, and will sometimes do long calls only. So there seems that that's a directional play as well. And also, I imagine, would involve discretion and directional trading capability over a long term.
I think that's true, Ron, but I think they also make sure that they cover both directions through using multiple advisors in some cases.
Yeah, no, maybe I should have started there. So I think the concept of not having one particular type of so-called hedge for a stock portfolio and having an ensemble like what he's done here, I think is a fantastic idea. And I think is necessary as well. Because what you'll find is that if you go back through two various crashes, the crashes are not the same, right? You'll have one crash that is, super fast, like the COVID crash that we had. But maybe skew does something completely weird, that's unlike what happened before. Or sometimes you'll find that the really far out of the money puts, like the so-called teenies that people buy, may absolutely explode during one type of crash, and then the other crash, they barely respond, right? So, or maybe the ones at 30 days explode, but then the ones that are very, very nearby, just a few weeks back behind that, don't react anywhere near as much. So you get that kind of stuff. So having the ability to spread your bets out with different types of hedges across different tenors or days to expiration and different types of strategies is ideal. I think that really is the way to go. So I really liked that concept of saying, it's not just one magic hedge. You really need an ensemble approach, similar to the way that Ray Dalio talks about the so-called Holy Grail, right? Where he says it's not just one system, not one trade. That's the Holy Grail. It's being able to have a series, half a dozen or more different types of strategies that are uncorrelated to one another with positive expectancy, right? So that when one dips, hopefully the others aren't dipping at the same time. So that is what he's basically saying in order to mine the edge, in a good way. This is Ray Dalio, but he's not talking anything about specifically about tail hedging, other than the fact that by having these uncorrelated returns, that they will essentially reduce the volatility of your portfolio. Jason is basically coming saying, yes, that's correct. That's what you want to do. But by adding the long vol specific plays in an ensemble itself, that is the best way to reduce your volatility even more, right? So I think he's definitely on point for that. But getting back through to the individual strategies, he also mentioned opportunistic strategies, which translated basically into directional short futures, which again is a directional play, requires experience, and likely involves discretion. He talked about rolling puts with Hare Krishnan doing that. That is likely to be more of a systematic play and more of a so-called pure long vol type of strategy. I like the fact that he said that he seemed to imply that they spread their, teeny buying across multiple days to expiration, multiple tenors, which I think is a good idea. And then, of course, he talked about the so-called dynamic VIX, which is VIX pairs trading, either through futures calendars or a pairs trade between VIX and the E-mini futures. So I think all of those strategies are very viable. Let's just put it that way. But if any of you have actually traded long straddles and long strangles, you'll know that they are tough, right? And I think that gets back through to what Jason was kind of alluding to in saying that, yes, you could do it as a retail trader, but if you try to do it, you'll likely find it to be quite difficult. And at the money straddles in particular are just, you are loading up on Vega, right? If you're planning just on trading that particular trade as a so-called income trade, right? In terms of making money from the movement of the underlying, and therefore you gamma scalp. And gamma scalp really just means that you're flattening your delta at the end of the day or after a particular, average true range move. Or if you have directional trading skills, you might say, okay, when it reaches, whatever, S2 or R3 or something like that intraday, I'm going to, rebalance my deltas there. Whatever
That's
strategy.
No picnic either, is it, to do gamma scalping? But I think...
Yeah, it's tough, yeah.
I think, maybe we can learn. See, it really surprised me to the extent to which these people are open about what their strategies are. And there wasn't time, but he offered to go into more details, but in a principle, but we just didn't have the time to go into. And if you listen to the interviews, many of them do go into enormous detail beyond what he did. And some of the strategies that you mentioned, the time or the tenors of the various trades, many of them, there's one guy in Europe, I can't remember which one, and one of the advisors, they have what he calls a whole bunch of little fellows. He has a whole bunch of competing time frames and tenors, and he runs them all simultaneously, and he looks for patterns to develop over time and to pick out which ones are best, which again sounds problematic, but apparently he has it working.
Yeah. No, I think an ensemble approach to hedging is the best way to go. Personally, that's my personal feeling, right? It's not just one type of thing. There's no such thing as saying the 5 delta out of the money put at 35 days to expiration is the best protection you can buy. That's complete rubbish, right? But having an ensemble of different strategies for hedging, I think is a way to go, because every crash is different. You just don't know.
Agreed.
Yeah. So so again, I liked his presentation in the sense that I agreed that all of the concepts or the strategies are very viable in theory, but when it comes down to us retail traders now, then, well, of course you can invest in his fund, but now you will need at least 100K and to be an accredited investor, right? Which means 200,000 annual income for 2 years or $1 million net worth, which not all of us have, myself included. So
that's right. Now you have your own community, which focus a lot on tactics for some of these trades. Have you come up with, I'm not really in touch with exactly what's going on these days with it. Have you come up with some strategies that I don't mean right now, but that inside your community, you're able to concretize to the degree that people can say they're working well?
Yeah, look, I came at things in a pretty different way, I think, compared to most traders. Most traders always focus on the income portion. And my feeling was that that was kind of like the easy part. The tough part was to not get wiped out once every few years or whatever, right? From that
Absolutely
huge crash.
correct.
Anyone that's traded iron condors knows that they work great for 10 months and then month 11, you get wiped out. So that to me was the key thing. So I kind of looked at it saying, well, I really need to approach this backwards. I need to figure out the hedging part first. And then once I get to a point that I'm comfortable with something that appears to work, then I can easily then slap on an income trade. And if on a net basis, the amount of money that you're making from the income trade minus the amount of money you're spending on the hedging comes out to be positive, then obviously that's good, right?
Are they fairly separable, the two?
Yeah, well, put it this way, the way that I preach when it comes to hedging is to really primarily look at two types of buckets, I call them, right? So one bucket is what I call proactive hedging, and the other bucket is reactive hedging. So what proactive hedging is that when we put on our income structure, then we always pair that with a so-called black swan hedge, okay? Because by definition, nobody knows when the black swan event is going to come. Otherwise, it wouldn't be called a black swan. So since nobody has that crystal ball, you have to always buy that insurance in the same way that you buy insurance for your car, your house, and your health and everything else, right? You don't know what day you're going to get in your car and someone's going to crash into you. So you have to have insurance all the time. So in the same way, whenever we put on an income trade, we hedge always. So that's proactive hedging. On the flip side of things, with the other bucket, there are instances where the market will try to, not try to, but the market will kind of show its hand a little bit and give you some clues that the type of, not just move down, but a certain number of variables seem to be lining up where for the ugly, really ugly crashes, they almost always tend to line up, right? And if you're basically looking at that type of thing, then you can say, well, maybe if I see them like all fire at the same time, as an example, then maybe this is not just a buy the dip type of opportunity. Maybe I need to get far more aggressive with how I hedge my downside. Okay, so if your normal type of hedging is just delta hedging through short futures, as an example, or short SPY, right, where it's purely just a delta hedge and no other Greeks, then that might be fine. But the second that you start to see a bunch of things line up that seem to insinuate that this could get really ugly, then at that point you might start getting more aggressive, right? So instead of just delta hedging, you're now doing certain types of option trades where you're going to get more bang for buck if the IV really does spike hard, right? Not just to protect your trade. That's a primary objective, of course, but some of my members actually do that on purpose, right? So they will essentially be directionally trading the market crash, if you like, to try and make money from certain type of structures. So that's what I call the reactive. Actually, you know what? I can actually show you if you want. Do you mind if I share my screen here for a sec?
Yeah, please do.
All right, I can show you an example of what I mean.
I mean, traditionally we have vol of vol being one indicator people use to watch out. And another
So can you see my screen here?
Yeah, can.
All right, so here's the COVID crash, right? So this is just an example of the type of thing that I'm talking about. So these are just some custom, when I said there are certain types of things that tend to kind of give you a clue that things may start to get ugly. This is what I'm talking about. Let me make that a bit bigger. Go this way and then go that. All right. So, I'm sure people are kind of, they have the magnifying glass out and saying, what the hell is it, right? So I'll know the mean to hide it, but this thing here is a custom unbalanced volume. And unbalanced volume is basically just the change from close to close multiplied by the volume of that particular day, right? So if it's a down day, it's going to be a down OBV move, but you then multiply that by the volume that happened during that day, and then that gives you that. Here I've got, my own way of looking at what is normal, what is abnormal, and so on and so on. But so that's OBV. This one here is tracks the average true range. This one here is one that was actually, this indicator specifically was made by one of my members, but basically tracks in a systematic way sentiment, think of it that way, basically based on mildly bullish, mildly bearish, or very bullish, very bearish, or neutral, right? So this one here is mildly bullish. This one here is mildly bearish. If there's nothing, it's neutral. This one here is very bearish. This one here is very bullish, right? So it's all color-coded in the sense that
it's very nice, very nice.
Yeah, red is bad. Purple is a bit bad. And then, cyan here is a bit good, and full green is, very good. So if you look here, then on this day here, if you look at that, this is basically February 24th, right? On this day here in our community, we were basically all sounding the alarms. Why? Well, because this indicator here that we track, it's something called the simple trend following system, right? But in a nutshell, to kind of put it simply, see how we basically closed underneath this particular cloud down there? So that is the first kind of warning sign that something could go wrong. But then if you look down here, you'll see that the dots basically went red, which basically means, bad. And this is the OBV tracker that we've got. Then we've got the ATR. The ATR basically went red. That means bad. This one here went neutral, right? And then this one here also went, I didn't explain that. This is what's called a force index. This was created, not this indicator, but the concept of force index was created by Alexander Elder. And
ATR is supposed to be a proxy for, or a measure of volatility.
Yes, sure. This is force index. You can just go to stock charts or whatever. It's nothing proprietary. Force index is basically just, the change in price here times the volume. That's force index 1. And then you basically take a 13-period moving average of force index 1, and that's force index. But we just have a special way that we track it with this particular indicator, so that we have certain levels and whatever that triggers when stuff looks nasty. But you can see here, it's basically gone full-blown red. Okay, and as a matter of fact, there's one more that I don't have on that screen, but it's this one here. Nope, wrong one. This is something else to track with just different ratios of market flows and so on, but this is the one that I want to show you. Yes. All right. So on this one, if I zoom in again. All right, so if you look at the date, just where my cursor is, see there? See how basically it went red? So what this thing here is, it basically tracks the term structure of 9-day, 30-day, 3 month, 6 month, 1 year. And all these dots here do, it just makes it simple to see that when the term structure flips. So what happens here is you can see that we basically inverted completely. And the 9-day went super high, way above all of the other terms here. And some of the others started to invert, but this was the other kind of signal. But, we were seeing signals everywhere. So you can see here, we're seeing even VIX popping out based on this indicator. If these lines here kind of go bold, then that is something that we kind of, keep track of. But in a nutshell, we had, 5 or 6 different things that were all lining up saying this does not look good. And that was on February 24th, right? So we all got much more aggressive on that particular day for the COVID crash. So that is what I mean by reactive hedging. Right.
So did you guys make out fairly well then over the COVID crash?
Well, yeah, and that's the purpose of having the combination of those two things, of the proactive hedges that you always have on for your income trades, and then being able to have certain things that you track. It doesn't have to be what I just showed you, right? It can be whatever you feel works for you as a trader, right? But having some degree of signals that you can track that say, if these things start to line up, and especially if they all fire at the same time, then, it doesn't mean I'm just going to completely pull out of the market, but I'm definitely going to get more aggressive with how I protect my portfolio, right? And that doesn't have to be systematic. That can be discretionary as well, right? That can be up to you. But at least it gives you a heads up that the crap could be hitting the fan soon, and of course you're going to get some some signals that aren't going to play out sometimes, but that's fine. And that's how we handle it. Yeah.
So if people want to find out a little bit more, they can check tradingdominion.com. And I guess you have normally the entrance to your community is to take some courses, paid courses to begin with. So people can look at that, and I'm sure they get value out of it.
Yep. Yeah. And excellent. I've got some presentations on YouTube as well on Weighted Vega and some other stuff if you're an optionist
Weighted
kind
Vega
of person.
And which course is the one that's on hedge or tail risk?
Right. So I've got two courses at the moment. One of them is what I call portfolio investing, which is this concept from Ray Dalio of being able to trade a series of strategies, ideally about half a dozen, but in an easy way, so that you have uncorrelated returns. Right. So that is one course, and think of that for more of the longer term type of investing, but you just rebalance once a month, 20 minutes a month, you're done. That's one, but that has nothing to do with options, right? So that's pure ETFs and understanding portfolio construction and all that kind of stuff. And then for the advanced option trading, then for that, I've got what I call the portfolio margin trading tactics course, PMTT. And that will teach you both income trading and hedging tactics, multiple strategies within that course. And that is what we're kind of alluding to here in terms of the hedging for the income trades.
Well, very good. I hope people check it out. Thank you very much, as always, Ron, for when you're able to make it and make a great contribution to this group. Let's see if anybody else has some comments. What do you guys think of the talk? Did people follow it?
Nice graduate level seminar.
Right. Now, we're all graduate students, right? I mean, what I thought was that it gives ideas for systems that we might trade. I want to develop some intraday systems for trading futures. I want to get some volatility trades. I mean, even if we don't get them working perfectly first day, first month, or first year, I think they would be a great asset to add to your trading. And also, I do think you can add hedging capability to some of your trades, as is, to some income trades, like Amy Meissner's trades, advanced asymmetric iron condor, or some of those. You can just, it's not too hard. Who else has already started looking or thinking about any of this kind of thing, or is doing hedging now?
I would like to see somebody walk me through the hedging trade sometime on another evening, not tonight.
That's right. Yeah. I think we do need to see. The problem is that hedging is apparently not regarded as a very sexy topic. People want to concentrate solely on, but it's actually, as Ron said tonight, and I would say, the most important thing is not necessarily hedging, but somehow preventing massive losses, because every time you wipe out your account by being over leveraged without having proper control of risk, you lose so many years off your life almost. You can learn from it, but people need to. Yeah, we'll look for. Ryan, did you do some trading like that?
I've dabbled in it a little bit, but I don't have a lot of extensive use. But
right. But you tried. I think you tried some back ratio trades. Do you have?
Yeah, I definitely had some success with it.
Great. Would you? So you think somebody could use that as a basis of setting up a running hedge?
You could. I think you need to watch it though. I mean, it's not just like set it and forget it.
Mhm. Absolutely not. Yeah. Well, if you get some, by all means, show them to us in some future meeting. If you get to that point, I realize, a lot of us are just experimenting still, but yeah, we'll
Do you
try.
want to see the Christian one?
Hare Krishna. What did you say again? Sorry.
Yeah, did you want to see that?
Oh, please, yeah.
Okay, because I can show it and it's
Please
quick,
do.
basically. But this is what there is. Oh, sorry, I'm not sharing music.
Is this one of the 1x2s or whatever? Or?
It's the one he talks about in his book.
Yeah.
So that's what it looks like here. Do you see that?
Yeah.
All right. So it's a one. Actually, Jason mentioned it as well, right? So it's basically your short is at 25 delta, and then you got two longs here at 10 delta there, and then that's what the risk graph looks like. And if you want to know the P&L, this is what the P&L looks like here through a back test that went back through to 04. All right, so you can see that basically, like with any type of hedge, you're going to be underwater. They're not money makers; they're there to hedge your income trade, right? So this is ideally going to be offset from the income that you're making from the income trade. But that's what it looks like. Just to give you a quick.
That's great, Ron. That's very helpful. And you ran this yourself.
Well, yeah, this backtest was created by one of my members in my community, but yeah, we have people that can run these types of things.
I want to run that same test myself, and I started to do it, and then we can experiment with it a little bit. Does that answer your question, Mike, or do you want to ask Ron anything?
Well, that's a fine start, but I'd like to get down in the weeds sometime.
Yeah.
See what the ground looks like around the weeds.
Yeah, we'll see what we can do. Anybody else have any thoughts on the meeting as a whole? Any other topic people wanted to bring up? Show any trades?
Just to say thank you for your leadership all year long. Thank you.
Well, thank you, Mike.
Yes, thank you, Don. We've had some great speakers, and tonight was very educational. I think you did a great job.
Oh, thank you very much. And, it's great to have your participation too, Ryan, and John's and Dave's and everybody's, including Ron's, of course. I'm going to try next time for a guy who's written a really great book, but I don't have it right here, so I won't mention it now. Or we may also have some other topics. Well, I guess we've got no more people who want to say anything. Thank you very much, and we'll call it a night. Thank you.
Thanks, Don.
Thank you, Ron. Good night.
See you later.